My name is Elisabeth Ottawa. I'm a member of the steering committee of the Regulatory Policy Committee of ICMA and head of Public Policy Europe at Schroders. Thank you for joining us for this discussion on the buy-side trading desk and how firms are navigating liquidity, technology, and execution in a market that is becoming every day more data-rich, more fragmented, we heard that, and more demanding, probably. I'm delighted to be joined today by 4 excellent professionals covering the breadth of today's trading desk. So here with me today are Lynn Challenger, Managing Director and Global Head of Trading, UBS Asset Management, Louise Drummond, Global Head of Investment Execution, Aberdeen Investments, Yannig Loyer, Global Head of Markets Liquidity Solutions, BNP Paribas Asset Management, and last but not least, Jason Warr, Managing Director, Global Head of ETF Capital Markets, BlackRock. Not a day passes by where we don't see articles about AI in the news, relevant for financial services, probably some of them written by AI. But I think it's fair to say that AI has now moved from experimentation into the live workflow. Now, let me start with this big topic, technology and data. I'll start with you, Louise. What are the 2 top production use cases you're seeing today across pre-trade execution or post-trade? And where do you still want to see human judgment firmly be in charge?
So I'm going to say what we've done in AI at the moment. We're probably at the start of our journey. And from my perspective, the first thing was to build an agent that would take away a lot of the heavy lifting in the team. So obviously the agent's got access to all our data, our processes, our policies, and being able to do that has just like freed up masses of time, which really helps people at the beginning. So RFPs that come in, broker reviews, we've been able to analyse that data. And also as well, if people, want to find something at their fingertips, rather than going through like pages and pages and pages, you can ask the question, it comes up with the answer. So that's really helped us. And I'll go on to how we're using the data in trading. So that's been the first thing. That's been really, really useful. And things like broker packs that we use as well, like for pre-trade data and stuff, they used to take us hours, and now we can get the data in those packs and they're done within about 8 minutes, and then we then give it to the person. So it is really, really key that we still have that governance around it, and we've got actually people looking at what we're producing and what's going out, out to the markets and internally. The second case we've used it is like 2023. We adopted no-touch trading, and that was more in our passive book and low-value trades. And that's grown over the last couple of years. So now what we've done with AI is looked at, our results from our no-touch trading and the automation piece, and then applying that to our other funds. So from a trading perspective, we have a very good idea of where we think we can adopt that next. But having AI and putting that over on top of it has given us the results a lot quicker and confirmed what we've thought. But again, everything we do has a trader or compliance or risk involved to make sure that those results are as we'd expect. And that also as well, that the client outcomes are as expected as well.
So a bit like a sounding board?
Yeah. It's the invisible colleague that everyone calls, AI.
Yannig, what's your view?
Yeah, I agree with Louise, first of all. I think we have to distinguish where we are today and where the future is going to show us. I think in the relatively near future, we'll see some part of the bond markets fully agent traded, from systematic investment decision made to smart order routing to RFQ to liquidity provision algorithm to ELPs and so on. And it's not far from where we are given the pace at which this is moving. But yeah, right now, and as far as long-only buy sides are concerned, I would say we have a lot of use cases of AI which are just beyond what is the pure action of trading, from pre-trade to post-trade. Incidentally, our very first use case of AI was about parsing runs, which was quite difficult to do with a deterministic model, but was quite easy to implement with the LLM. From pre-trade, KYC onboarding to broker selection to a certain extent, to post-trade, identifying outliers, which trade the control team should focus on, settlements and so on. There are plenty of use cases which can be where AI can enhance processes and make us much more efficient. And now we have to look at where this plays into the actual trading itself. And we have the same issue, I would say, with AI than we have with LLM than we have with the deterministic model before, which is we cannot let the model make decision as you pointed out. And that means a certain level of control. And the approach we have taken on our side is always to augment the physical human trader with data, with information to make the decision at the right time. And the limitations here are the same, which are the quality of data, the accessibility of data at the point of trade, and the interface between the trading system and this real-time data to make the decision. But we are getting there very quickly, I think.
Let's stay with technology, but look a little bit more at the market structure. We heard in the previous panel about the potential of tokenization. So there is indeed a lot of talk about tokenized instruments and with that also 24/5 trading. What do you think is the most realistic near-term impact on buy-side execution? New liquidity, more fragmentation, new operational risk, or a change in client expectations? Maybe Jason, you first.
Sure. So I think the client expectation part that you finished the question on is one of the key parts here. I think there's an increasing expectation from investors and clients, I think, for always-on markets and the ability to trade 24/5 and perhaps even 24/7. So I think that's where the changing sentiment is going to create challenges, I think, for buy-side dealing desks. There's clearly an operational challenge as we think about that, and I think the buy-side dealing desk challenge is to separate the observation environment from the control environment, i.e. the periods where you'll be observing what's happening, but you may not be able to interact with those marketplaces for a number of reasons, perhaps liquidity, versus the control environment where you will actually be executing and trading. And that clearly has implications for pricing and benchmarking as well for your executions. I think clearly tokenization, I think as mentioned on a couple of other panels earlier on, has the ability to make parts of the ecosystem much more efficient and much more resilient. And I think that's something that we're in that transitional period right now. So therefore, I'm very sympathetic to some of the operational challenges that many firms, if they're not facing them now, will be facing them in the coming months to try and integrate these 24/5 digital markets with our analog markets, as was referred to earlier on. But I think the opportunity is there, particularly on things like collateral usage and settlement, to bring real efficiencies to trading desks. But it's managing that interim period of transition where we are today between what's executable and where liquidity is and where it's not, with that increasing client expectation, I think, particularly from retail investors, to access markets at all times of the day.
Lynn, would you agree?
Yeah, I would definitely agree. I would also just kind of separate the two a little bit. So I think digital technology, for me, is more about the layer one, the settlement structure, the structure of the instrument that you're trading, but the actual trading of it, I don't think is going to change at all. I mean, if you look at the way Bitcoin trades, it's very similar to a currency or another central limit order book. So I think trading will always exist sort of at the level 2 or level 3 layer. And then in terms of how that'll drive the innovation of markets, I mean, we already have 24-hour tradings through Globex or through currencies. I can trade U.S. Treasury bonds any time of the day. So there already is 24-hour trading in a lot of different markets. I think the push for the U.S. market to become 24 hours trading is going to be quite interesting. I think because when you look at liquidity and how liquidity manifests itself, during the U.S. trading hours for U.S. stocks, there's a lot of different market participants between institutional, retail, options hedging, relative value hedge funds that all participate and develop a deep liquid market. Now, keep in mind, at 11 a.m. in New York, I'm very careful about how I trade a US stock because liquidity goes down. Now, if I move that to 11 p.m. at night, this can be a different metric of how we're going to trade, where it's mostly going to be, I think, mostly regional retail orders trying to interact with the market and trade it. So I would think from our perspective, we absolutely will not be a liquidity taker in those markets. But opportunistically, we might be able to step in and provide liquidity to the market if we're working a limit order from an order we had not completed during the normal trading session. So I think we have to be very careful on how we interact with the market. And then but I think over time we'll see how liquidity transpires. If the market really does take off and there's more diverse liquidity coming in, then perhaps we get more hyperactive and trade all throughout the night.
So much more of an evolution rather than a revolution?
Yes, with some speed bumps on the way. Yeah, I would imagine a little mini flash crash is kind of potentially occurring over the night where there's just a spike in demand for liquidity for a single security, and there's just not that ability to hedge and lay that off, so the opposing liquidity just will disappear.
So no rest for the wicked, I
No.
guess.
Let's take that straight into best execution, because I guess continuous markets and new instruments make the evidence question harder, not easier. So we heard that technology is changing the toolkit, and the market structure is shifting around it. Then what does good execution actually look like today? Lynn, let's continue with you.
Sure. So I would first start off and say just the difference between best execution and good execution. One is a subset of the other, I think. Best execution is more of a compliance level term we use for did you take sufficient steps to achieve an outcome for your client. That doesn't mean those sufficient steps end up with a good result necessarily in terms of was it a good execution or not, but it's actually you're just logically following a process. When it comes to the quality of the execution, we like to measure it in two different ways. So I think if there's a liquid market with price transparency, like in the equity markets, then we kind of think of it as a portfolio manager handing a baton off to us. And so as soon as we grab the baton, it's our time to sprint. So we like arrival price, and then we kind of look at the optimization of duration risk versus impact, and we try and measure ourselves versus that. So our benchmark might be VWAP or PWP, et cetera. In the fixed income market, that is different. We definitely are not in a position to be passive or provide liquidity into the fixed income market. I know there are new tools and all-to-all trading or other venues that allow us the opportunity to, but on a percentage basis, that's just a very, very small percentage of how we're interacting with the market. And I think we can talk about why later when we get into technology and what's important there. But with fixed income, for us, it's really about how do we measure the liquidity we're finding at that time. So we look at bid-ask spreads that we're actually facing when we go out into the market. We look at the depth of the book, the time it takes to quote, the number of banks that'll DK us, and then we kind of measure our impact on how we can control those spreads through relationships and through our trading behaviors. So slightly different in terms of equities.
Sounds a bit like a disconnect between, maybe the compliance side and the outcome perspective.
Probably got myself in a little trouble there.
Louise, having listened to Lynn and the different aspects, from your point of view, what matters most at the point of decision? Price, certainty, completion, speed, minimizing information leakage, compliance?
Yeah, all of that does, and it obviously just depends on the trade, right? It depends on, like whether you need to do that quickly because someone might want to exit something, so maybe, price is still a factor, but it's the execution of getting it done, the certainty. On a much larger trade, it could be market leakage, so all those variables move around, and I think that, when we come to compliance, we're both looking at it from different lenses. So the trader will know more about, about the journey of that trade. So back to the point that Lynn said, something's really liquid, you're not going to get any questions, from compliance. It's probably the trades that might take longer or the price isn't where they can see the price is. And I quite like those discussions because we're both trying to get to the same thing, but we're just looking at it in different ways. And so they might be thinking about it from a price perspective, but we're thinking it more about, you know, what really, when that trade hit the blotter, what was the intended outcome? What did we need to do on that trade? So, you know, quite often we can, you know, when we have large trades or, you know, a trade that needs a bit more of a story, we actually are looking at the markets maybe like it could be a day or 2 days before, or it could be 1 or 2 days afterwards. So that actually we can talk through compliance to, you know, the decision making that led to the outcome.
So it's almost like a Venn diagram that
Yeah.
needs to come together.
Yes. Yeah.
Yeah, I mean, I guess as firms try to weigh those factors and make them more consistent or complementary, I guess the quality and availability of the market data becomes a much bigger part of that equation. Yannig, the US has TRACE for a long time now, and Europe, we've heard it in the previous panel, is in the middle of building its consolidated tape. Yeah, it's been there as a discussion for quite some years. What does this mean now that Europe is perhaps catching up a little bit, mean for competitiveness and deeper pockets?
No, the tape is coming and it's transformational. I said yesterday, it's not about whether the tape exists anymore, it's how it is used now. And it's a big difference between snapshots of liquidity being reported in different places on the one hand and a global unified data source for all trades. So it's great that this is getting there, and that will definitely democratize the access to trade data and data in general, and that will make access to this past trade data easier and cheaper, which is great for, I guess, everybody. That should mean, for instance, proving best execution in general cheaper than it was in the past. For if I look at the buy side aspect, and a number of pre-trade processes, selection and so on, much easier. Now, we know there is a balance between transparency and liquidity, and there have been a lot of discussions on how much transparency we should give into the fixed income markets and so on. We have to be careful, and the same will apply there, in the sense that the larger trades will not be democratized with the tape, or best execution on the large trade will not be democratized by the tape, as I was saying before, because there are much less trades that are large blocks and so on in the tape, number one, and two, the deferral process will make that this data will not be readily accessible to best execution. But that's good. Let's keep the deferrals and so on, because it's a trade-off between, again, transparency and liquidity, and we've got to be very careful on that. So, but my point is to say that for larger players who have larger blocks to trade, the tape will not be that useful for larger trades, but will be of great use for the vast majority of trades.
Okay. Jason, having listened to Yannig, and he also mentioned democratization. So will better post-trade data democratize best execution, or will firms with the deepest pockets still extract most of the value?
So I think it would help significantly. And to your point about the US having had TRACE since 2002, they've also had an equity tape since the 1970s. So two things we're trying to get forward in Europe is both a fixed income and an equity tape, which I think are critical. And just building on the democratization point, that extends from retail platforms across Europe right through to smaller asset managers who don't have the deep pockets and the deep data resources. So it is going to be leveling the playing field. Will it be in a perfect leveling of the playing field? Perhaps not. There will still be deep pockets will help in some scenarios. But it's a significant step forward, and I think to the point you made in terms of the competitiveness of European markets. And that's really the kind of the call to action, I think, for this room, which is we are going to have a tape. How that tape is built and how that tape is implemented is the critical part now, and ensuring that for the market participants in this room, we don't allow our competition between our different purposes and our short-term goals to get in the way of delivering what's such an important thing for European capital markets, to enable them to be much more competitive and attract global capital so that global investors into Europe aren't underestimating the liquidity that's here in Europe, and there's a full transparent picture of it. So for me, that's the two critical points. It's the leveling the playing field right from retail, when most retail platforms don't give you execution benchmarks at the moment. This provides a way for retail platforms to cheaply and accessibly get access to that data, and for investors to demand that as well. And then the European competitiveness point, for me, is critical. And we're at this crucial point right now where if we don't do it correctly, it'll be a missed opportunity that we may not get again for decades.
Mm. So should the US be concerned?
We should be optimistic.
Can I interject there in a second?
Yes, please.
I just wanted to make one point on that. And I think when we think about liquidity, I think about it a bit like compute and like data. The more you're able to stream data, and the more people are going to use it. The more Wi-Fi that's available, more people get online. The more compute you have, the more people are going to be using that compute. That's the whole argument with AI right now in the data center build out. I think the same thing happens in financial markets. The more transparency you have, the more liquidity you're going to have, the more participation you're going to have. So I think the tape, however we launch it, is absolutely critical to just get it out the door, even if it's too small or trying to find the right size. It doesn't really matter.
No.
Let's start small and then let's grow from there. And we'll figure out where we're trying to protect the risk takers and the higher end of liquidity on block trades versus just getting that information out to the market so that we can get more participation and grow the markets more.
Yeah, so the first step is really the most important one, I guess. Yeah.
Exactly.
Louise, do you want to chip in as well, or?
No, I was just going to say, I agree with the points earlier that one, it's a level playing field because, you know, the data's been out there, you know, like for years, and it depends back to the point how deep your pockets are. So if you've got really deep pockets, you probably had that competitive, you know, advantage. So now getting a tape at a low cost, you know, it's up to you how you want to use that. So whether you know, take the data directly yourself or whether you're using it through probably some of the trading platforms, it's really good. And also as well from a retail perspective, I think it's great as well that retail, now if they're on platforms, should be able to see pricing as well. So then we're encouraging retail to invest in markets.
And making it much wider than
Yeah.
it is now.
Yeah.
Let's move from the execution quality to the market conditions underneath it, with liquidity certainly being at the front and center, and it was touched upon in the previous panel as well, and you mentioned it also, Lynn. Yannig, with the developments that we're seeing, some say there might be less liquidity, but Lynn thinks that's not the case. So are we seeing indeed less liquidity, as some may say, or just a different kind of liquidity?
How much time do we have?
We still have some more questions. So.
No, we can speak for hours about it. I mean, market structure is evolving, of course. Together with data, actually, to linking to the previous point, the growth in fixed income ETF market, for instance, thanks to you, Jason, has changed the market structure in fixed income, making ETF as a source of liquidity, portfolio trades, ELPs backed by data, and so on. So that has changed liquidity aspect a bit. Data and the tape will keep changing or evolving that. Now, at the end of the day, fixed income remains an OTC market, and there is a buyer and a seller, which are two balance sheets agreeing on a price for an asset. So at the end, the liquidity is evolving, but the fundamental markets of the markets are not evolving that much. It's just the way the market behave upon certain events and how they adapt to different events. Something very positive, and I don't know whether my co-panelists will agree, but I was thinking about that this morning. But the last big disruptions in the fixed income markets, I believe, were the mini budget in the UK, and prior to that, probably COVID, where people didn't know whether there would be tomorrow or not, and traders were not physically at their desk and so on, complicated to trade. But otherwise, we've seen liquidity generally behaving and not being disrupted over the past crisis, be it the recent one or Ukraine before and so on and so on. So I think that's a very positive for the market, making that the market reacts more quickly, adapts more quickly to changing environment. We have increasing volatility in geopolitics and so on, which makes the market regime change more quickly and more regularly than before. But I think the evolution to this new regime comes more quickly, maybe thanks to this liquidity source.
Louise, where do you see improvements in the, let's say, last year or so?
When we're talking about liquidity, I always think there is liquidity, just different types of it. And I don't think in all the years that I've been trading, I haven't traded for a few years, but when I'm observing, we've never had issues, in being able to execute. And sometimes you might need to change maybe the instrument, that you're looking at getting exposure to markets. For us, probably what I've seen more usage of probably in the last year is PTs in fixed income. So again, that's evolved incredibly. And I remember when PT started, I remember a sales guy coming in and telling me this was going to be the new way of trading, and I laughed at them and just said, you must be joking, like ringing up and just saying to him, can you price all these trades for us? No, that's our job to do it. And now you just see that works so efficiently of getting the results that you need as well.
So you need to be more agile, more versatile?
Yeah. I think you do at times, not all the time, but yeah. But I think again, so that comes down that AI can't do. It goes back to the experience of a trader.
Yeah, I do wonder with that, although that moving to AI, how do traders in the future get that experience if most of the junior work is done with AI?
I'll come up with some thoughts, if that was a pause. So one thing we've been discussing internally is maybe two parts, and this is going back to the first question around AI, is one, what's the framework we think top-down in terms of how we want to apply AI to our execution processes across asset classes, across markets, across different kind of market conditions. And one part of that is to think about the human role in that, and the human does play a role in all three of these scenarios, but it's either a human in, a human on, or a human above the loop scenario, which is really dependent on the asset class, depending on the market and the conditions. And then another way to think about it is, what are the consequences and confidences you have in those processes? So i.e., where do you have confidence in the ability for AI to augment a trading process where the consequence is low? Okay, those are scenarios where you can probably deploy more augmentation of trading flows versus situations where you have less confidence in the output of the models and the agents you've been developing, and the consequences might be higher. Those are the areas where the human involvement would be in the loop, as it were. That's part of the framework, how we think about of the application of AI to our processes.
Okay. Lynn, what's your take?
Well, yeah, my take.
Not only on the how do people learn in the future, but on
I think how many people are willing to get into a plane without a pilot is the first question I would have. So there's a layer of AI does a lot, but really when it comes to judgment, you want to have a human on top. I think at this point, I mean, who knows where AI is going to go? But I think making sure we always have that human who's able to apply the judgment on top of the AI, and the AI is more of an augmentation tool in the trading desk, I think will be the first thing we start to see.
Just on that, the airline point is a really powerful one, because when you think about how we train pilots, you don't send a pilot up in the air, have them fly around for hundreds of hours and hope the experience is difficult conditions. You put them in a simulator and you throw all those conditions at them over a period of days and weeks and months. So that might be how we train traders in the future. We simulate the market environments that, hopefully I'm not being rude if I say that most of us have lived through a number of different market conditions. How do you simulate all of those into a short period of time to give younger, inexperienced traders more experience of that? So I think that flight simulator concept actually is one that could be applicable to our businesses.
I like that.
That's a great point.
But Jason, just quickly wrapping up on liquidity. In this context, ETFs are increasingly used as liquidity tools. Do they reduce the execution risk or shift it, or where do you see ETFs in that debate?
So I think broadly speaking, and this probably won't be a surprise to the audience, we think ETFs are additive to liquidity. And in some asset classes that becomes particularly relevant. And I think, as you mentioned, in fixed income, through the periods of volatility we've seen in 2020 and 2025, it's provided us lots of rich examples of how fixed income ETFs behave in those environments relative to the underlying bond markets. So a good example would be in high yield, for example. If we compare 2020 in March to April 2025, clearly different markets environments, but both had periods of volatility. In those environments, the ETFs made up in 2020 75% of the high yield trading that happened, whereas in 2025, they were 110% of the high yield trading that happened. So I think broadly speaking, we see fixed income ETFs as being additive to liquidity, acting as a release valve in many cases, where accessing liquidity in underlying bond markets can be more challenging. We're seeing that there's increasing activity in ETF markets. We also see increased number of liquidity providers interacting in those markets. So when those markets get more volatile, we see more fixed income ETF trading, creations and redemptions, i.e. more participation in those markets. So I think that release valve concept is the role that ETFs definitely played in the fixed income space and clearly across other asset classes as well.
Can I add to that?
I think.
Sorry,
go ahead.
I don't want to talk too much.
No, I would slightly object to that. I get these numbers and since they work, and we've seen ETF playing an absorbing role in I would say limited crisis so far. They've not been tested in really crisis conditions like we've seen in the great financial crisis and so on. Hopefully we won't see that anytime soon. But at the end of the day, the point I was making before about someone buying and someone selling, ETF portfolio trades, ELPs are kind of facilitating liquidity in benign environment, are probably not transferring risk from one pocket to the other. So at the end of the day, they're probably adding limited liquidity and in relatively benign environments.
Yeah, I was just going to say those great points, by the way. What the ETF, I think, has done, especially in the fixed income market, is it's enabled balance sheet management. So in the old days, you had to have inventory really to be a bond market maker. But now you actually don't have to have inventory because you can create and redeem that inventory very easily through the primary markets and ETFs. So that allows more market participants to come in and actually trade on a very large scale, multiple different bonds, because they can actually move their inventory back and forth through the ETF. In order to do that and do that efficiently, you've had to create central risk books. And I think the market makers have been very good at creating central risk books where they're not so worried about the individual ISIN, but they're more worried about the macro risk that they're having and how they're hedged. And so what that has done, that's been able to translate the liquidity from the ETF into PT trading. So PT trading exists because of ETF balance sheet management and then the central risk book being able to manage that at the aggregate sort of macro level. And those sort of things all combined into more liquidity to the exchange. So not only do you get more liquidity just out of trading the ETF, but because the ETF exists and how people can manage their balance sheet.
I might just add a third leg to the stool that we're building here. We've built a two-legged stool, which is the complement between PT and ETFs, which I think is a very rich one, and I think is definitely helping balance sheet management, etc. The third one is the growth of algos from bond trading perspective. As in, I think as banks and other liquidity providers are producing algos that are resulting in having positions which are far broader and shallower, i.e. they are effectively creating portfolios of bonds by doing more algorithmic trading of single line items. That's creating that inventory that looks just like a PT trade and looks just like an ETF. So for us, it's those three legs of that stool that are complementing each other to drive liquidity across all three: bonds, ETFs.
Well, Yannig warned me that we can stay here for the entire day talking.
We can.
But now, having covered those big structural questions in a little bit more than 30 minutes, let's wrap up with a more rapid-fire finish. And I have two questions for all of you. How are you preparing for the future? Not only with maybe the flight simulator. And the second one would be, whose role in the market do you least envy at the moment? Louise, let me start with you.
Do you want me to ask both questions? Yeah.
Yes.
No, so I think
maybe one fits the other.
Yeah. So I think the first thing is you just have to make sure that whatever you're building, obviously that it's you're building your systems, your processes, procedures, that everything is adaptable and can change. We're not rigid in, like setting things out and then we find out, in 6 months, a year that we can't move as quickly as we want to. And then I suppose what role don't I?
Least envy.
Least envy. I just think there's not really one role. I would just say everyone's got to, back to the first point I've said, everyone does need to adapt and change and evolve. And if you can't do that, then I don't envy the role that you're in now.
My turn. I would say technology is the thing that we want to be set for the future. And that's because if you think about how the old buy side used to trade, or we still trade in a way, portfolio manager comes up with an idea, they create an ISIN, they have to build the trade across 30 different accounts, then they got to run it through pre-trade compliance, then they need to get the ISIN to the trading desk. And if we're in a world where we're starting to look more at factor risk in fixed income or beta risk in fixed income, that ISIN by the time it hits my desk may not be the right bond to trade at that moment, but I'm kind of stuck with it unless I want to send it back and then have the PM redo that whole process again and send me a new bond. So we've got to figure out how do we actually, on our side, become more dynamic so we can interact with things like all-to-all, start providing liquidity to the market and being able to be dynamic across ISINs. So I think that'll be important for us. And then whose job besides mine, do I least envy at the moment? Coming out of a merger, by the way, 2 years. I would say just in the short term, I would say it's a new college grad because we're trying to figure out what we need in terms of staffing and people. And the easiest thing right now is to say, well, maybe we don't need juniors. We, of course, will need juniors, and maybe they come through flight simulators and they're seniors, really quickly. But I think there's just a disruption in our market right now, in our hiring market. And I kind of feel bad for those people where we're going to need them. We just might not need them in August. We might need them a year from now or 6 months from now.
Yannig.
How to prepare for the future? Dealing with here and now is a good start. No, otherwise, I would agree, investing in people and in technology that is agile and people that are agile as well, because the future is evolving as we speak, so we need to adapt. Darwin is a first and foremost principle. Which role do I not envy? There is a running joke at a big American bank, some of you probably are in, which is that if the phone was invented today, compliance would have banned it from the trading floors. So I think compliance officers, I respect them a lot, of course, have a very difficult role today to adjust to a constantly moving environment and some technologies that we don't completely understand and control. So I think that's the first part of the answer. The other part of the answer is that at the end of the day, the easiest roles are going to be taken over by AI. So the roles that will remain are the difficult ones. So and probably not that viable one, but I think we have to estimate ourselves lucky to have one of these.
Jason.
Probably three parts to the preparation for the future. I guess one is what we're learning right now is that our technology systems need to be much more flexible, modular, and adaptable. When you think about the changes that we're making now, having to re-platform every time a significant change is happening in the marketplace. So therefore, building our technology in that kind of modular stack fashion to enable us to be more flexible. Secondly, as has been mentioned, the investment in people and processes, how we train and how we grow talent in the future is going to be different. And we can't just expect that to happen. I think we need to be proactive, and maybe it's flight simulators. Maybe that'll be my side business after this. And then thirdly, it's the engagement to my earlier comments about the consolidated tape. I think that need for active industry and policy engagement from all market participants will be how we'll shape a more competitive European capital market in the future. As far as the job I'd least like to have in this environment, it probably speaks to the combination of analog and digital. Being one of the operational leads that needs to stitch together these two markets from a data, from an access, from a settlement, from a collateral perspective, I think is going to be a challenging task over the next couple of years, optimistically speaking, with a good outcome.
Very good. That brings us to an end. What I hear from this last round are really, the main factors are agility, flexibility, embracing technology, and not losing the concept of rethinking human resources and how we keep and build talent in the future, I guess, in the industry. Well, thank you all very much for this very, very rich discussion. And a big thank you also to our audience, and I wish you all bon appétit.